Hi learners, welcome to Economic Term of the Day. I am Ramesh Singh with you. As you know, in this short video, we attempt to give you idea about one term of economics in one video in simple way so that you can use them in your exams in the right way. So, in today's session, I am in front of you with a term quite popularly used in monetary policy of the Reserve Bank of India, and the term is Liquidity Adjustment Facility, shortly popular as LAF. Let's see what exactly it is. Just say Liquidity Adjustment Facility. It is one of the tools which are used by RBI in making of monetary policy for India. Clear? It means कि in making of monetary policy for Indian economy, RBI uses LAF as a tool. But this tool did not come into being overnight. It evolved over time since late 99. Okay, and what exactly it is? It is the combined operation. Mind the word, it is combined operations of repo and reverse repo. It means कि either RBI says repo rate or reverse repo rate, but when RBI means both at the same time, RBI uses the term Liquidity Adjustment Facility. It means कि it is a term which basically has two terms inside it, repo and reverse repo. Now you must be knowing, as you might have seen my previous videos in which I have discussed about repo rate as well as reverse repo rate. Repo rate is actually an interest rate at which RBI lends short-term loans to banks, and reverse repo rate is the rate, interest rate at which RBI borrows short-term loans from banks. It means कि repo and reverse repo, they are two channels. Through former, money moves from RBI to banks, and from the latter, money moves from banks to RBI. Okay, and what kind of money? This money is always for the use of short-term period. It means कि either overnight or up to 28 days. Right now, though repos are of many kinds, beginning from 1 day to 28 days, but the reverse repo is not of term kind. So term reverse repo is soon to be put in place by RBI. Okay, up now say it means कि these two rates which are parts of LAF, they provide two-way channel for movement of short-term fund. It means कि from RBI to banks and from banks to RBI. This is what I mean by two-way channel. Okay, कि suppose कि in economy in Chennai, short-term fund is more than it is in demand, and in Delhi, short-term money is less than it is in demand. So through banking channel, this gap of short-term money is filled up. Did you understand? This is what we mean by two-way channel for movement of short-term fund in India's financial system. Clear? And in case of India, LAF is considered as the most useful tool for management of money market. Why? Because LAF LAF influences money market of India. It influences money market of India directly, and from money market, stakeholders are involved in lending and borrowing short-term capital, because short-term capital, that is up to 364 days time. If somebody needs short-term capital, that is also known by other term, that is working capital. The working capital requirements in an economy is borrowed from money market of a country, and in money market RBI might be lending or it might be borrowing. That is why two rates are announced by RBI, repo rate and reverse repo rate. Since it affects money market, since money market operates on LAF, it directly influences capital market. Capital market deals with basically long term arrangement of fund, and here long term stands for basically minimum 1 year or anything more than 1 year. Okay, now the problem is that why the rate on which money market operates has direct influence on capital market. There is a reason. Actually, movements in these two rates, that is repo and reverse repo, have direct impact on operational cost of banks, ultimately influencing their lending rates. What happens? When banks are borrowing at repo rate and repo rate is increased, so their cost of borrowing working capital also goes up. So they are forced to increase interest rate of the loans which they have already offered or which they will offer right now or from tomorrow. It means banks which lend to customer for long term, other than lending to RBI for short term, and other banks, they basically lend money for long term needs also. If operational cost of bank goes up, the lending rates of bank will goes up. It means through money market, RBI with the help of LAF influences the operations of capital market also. This is all about liquidity adjustment facility. I picked a term which you might have seen appearing in media regularly, and that term is open market operations, shortly known as OMOs. OMOs. Such operations are today popular across all major economies of the world. Let's see what exactly OMOs are. Open market operations, it is one of the tools which was launched by RBI in year 2000, which is used by RBI to operationalize monetary policy. It means monetary policies which aim at right sizing and right costing the fund in system. It must be having some aim, the right sizing and right costing. You can insert right word here also, so that there is no confusion in your mind. How much fund economic system of India needs, at what cost? These two variables are decided with the help of a monetary policy. In making of monetary policy, open market operations are used as a kind of tool. Let's try to understand what is done under it by RBI. So RBI sells and purchases government securities, short term as well as long term, under it to right size the fund in the system. If you try to know what are basically short-term government securities and what are long-term government securities, the short-term securities are treasury bills and cash management bill. Long-term securities are normally called as G-Secs of different maturity period. So what RBI does, कि from market of India, from India's financial market, RBI either purchases them or sells them off. What is the aim? Aim is to right size fund in the system. If economic system is having less money according to RBI, so what RBI will do? RBI will start purchasing these securities. Money will flow from RBI to economic system and fund is right sized. Opposite to that, if economy is having surplus fund, then in that case what RBI can do? RBI will start selling these securities. When RBI sells these securities, people buy, stakeholders buy, the money moves from buyers of government securities to RBI. This way, right sizing of fund is suitably done by RBI with the help of open market operations. Okay, it influences cost of fund also. Look, I began with size and now I say it will influence cost also. Why? Because suppose in a system fund is increased, so its cost will go down. Suppose in economy size of fund is decreased by RBI, so its cost will go up. This is simple mechanism of demand and supply. Okay, it means कि OMO primarily targets size of fund, but it is able to influence the cost of fund also. Clear? To make it more sensitive tool of monetary policy, the government allowed individuals also to trade in government security, and right since 2020 to 2023, even individuals can open an account with RBI, that is known as RBI Direct, and with the help of this account with RBI, this account is today opened by RBI free of cost for any individual citizen of the country. So through this account, even individuals in India can sell and purchase government securities. It means when RBI is operating open market operation, so we are also one customer group as an individual. Clear? So this is about actually the open market operations. Actually, in comparison to developed economies, particularly USA, in India, open market operations have been less sensitive tool. The main reason was that individuals in India were not allowed to trade in G-Secs directly or short-term securities. Now they are allowed to trade in them. So it is believed that anytime soon India also have open market operations, a very dynamic tool for RBI aimed at framing right kind of monetary policy for the economy. This is all about open market operations. Today I have picked a term that is MSS, Market Stabilization Scheme. Let's see what exactly Market Stabilization Scheme is. It is one of the tools used by RBI to operationalize monetary policy, and this tool was launched in 2004. There is historical significance of this year. I will let you know, okay, soon. But to the extent monetary policy is concerned, what is aim or what are aims of monetary policy operationalized by all central banks in the world, our central bank being the Reserve Bank of India. So precisely speaking, monetary policy aims at right sizing and right costing fund in the system. Here system stands for financial system, financial market. When we say size, it means how much fund is adequate for economy and at what cost. Here cost stands for interest rate. Okay. So actually when it was launched in 2004, it has very precise aim, but over the time it emerged as an independent tool of operationalizing a desired kind of monetary policy. Why it was launched in 2004? It was primarily launched to check inflation from rising. Okay, you might have read in books that from 2004 in India, inflation rate started rising. Okay, and particularly in between the period of 2009 and 2013, it peaked to very high level. Since then, it has started falling down. But first rate of inflation, which was seen by government in 2004, this scheme was launched by Government of India, and responsibility to operationalize this scheme was handed over to RBI. Let's see what is done under it. Under it, government securities are traded by RBI to target and stabilize inflation. When we say government securities, we mean short term and long term securities. In short term, treasury bills and cash management bills come. In long term, G-Secs of differentiated maturities come. What RBI does under it? RBI, if it is targeting a rate of inflation, and if economy has more fund, it will be resulting in higher inflation. If economy has lower amount of fund, it will result in lower inflation. So what RBI does, by selling or buying these securities, RBI aims to stabilize inflation and target inflation. When we use stabilize inflation, we mean WPI based inflation and CPI based inflation. But when we use target word, we mean only consumer price based CPIC inflation. Clear? Now, it has the feature of SLR, statutory liquidity ratio. What does it mean? Suppose RBI is selling securities, then money is flowing from RBI. Sorry, this is a mistake. When RBI is selling securities, the money flows from economy to RBI, and size of fund goes down. It checks inflation from rising. When RBI is buying securities, so what happens? Money flows from RBI to economy, and as a result, inflation can be increased. Clear? As a result, in such a situation, if inflation is too low, the RBI can intervene with the help of MSS, and inflation can be increased also, because without decreasing and increasing inflation rate, it can neither be stabilized nor can be targeted. What do you mean by SLR feature? If RBI is selling securities, the money is flowing to RBI, this money is locked till inflation cools down. Opposite to that, when RBI is buying securities, the money is flowing in the system. So now this money is being used by RBI to support inflation go upward. It means that over the time, market stabilization scheme emerged as a very crucial tool for managing a dynamic and required kind of monetary policy by RBI. This is all about market stabilization scheme. Today, I have picked a term which keeps appearing in media regularly, that is call money market. Okay, let's see what exactly this term is. It is one of the tools used by RBI to operationalize monetary policy. But you don't find such a tool available there. What exactly this term is, you will understand soon. This is actually an interbank market for short-term fund. Let me give you idea that monetary policies announced by central banks are aimed at right sizing and right costing fund in the financial system. Right sizing and right costing. Sizing means how much money Indian economy needs in case of RBI and at what cost. It means that monetary policy particularly aim at size of money in the system and interest rate of money in the system, and for that purpose call money market plays a very important role. This is shortly known as CMM also. This is an interbank market for short term fund. It means that in this market banks lend and borrow money for short term. Here short term presently stand for 1 day to 28 days. 1 day is repo and 28 days, 7 days, 14 days, 28 days, they mean basically term repo. Okay, and at which rate this actually operates. Okay, the call money market operates at the repo rate of time. It means that what is benchmark rate for call money market? It is repo rate of the time, the interest rate at which RBI borrows to banks money for their short term requirement, for their working capital requirement. Actually in this market there remains always a huge demand of money, and at times as much money banks wanted to borrow for their short term needs, they were not able to borrow. So later on call money market was expanded. In this market insurance institutions, it means insurance companies, NABARD and mutual fund companies were also allowed to operate, but only as lenders. It means that banks are the institutions which can lend also and borrow also. But in call money market, other than banks today, insurance companies, NABARD, mutual funds also operate and participate, but they operate not as a borrower. They operate exclusively as a lender. Why? Because these financial institutions are flush with fund. they always are available with thousands of crores of rupees which they might not need to use in short term. So this permission coming from RBI allowed banks to fulfill their needs of working capital and short term fund at one hand. On the other, it gave a kind of an avenue to these institutions to earn a little bit profit also out of their idle money, because when you borrow from this market or lend to this market, you earn interest, and that interest is repo rate of the time. Now giving you some examples, day-to-day rates at which short-term funds are available in this market are commonly called as call rates. See, this keeps coming in media. What is call rate? The call rate is actually the rate at which, the interest rate at which in a particular region banks were able to get short-term fund. In case of India, one such call rate is popularly known as MIBOR, that is Mumbai Interbank Offer Rate. It means that MIBOR is the call money market rate at which on a particular day in Mumbai, banks were lending and borrowing short-term fund, which is designed on the lines of London Interbank Offer Rate, that is popular as LIBOR. It means that in London, at which interest rate banks were lending and borrowing on a particular day, that rate of interest is known as LIBOR. It means that MIBOR and LIBOR are nothing but call rates of the call money markets of London and Mumbai. One belongs in UK, another belongs in India. Clear? So call money market is today used as a tool by RBI to operationalize the desired kind of monetary policy for India's economy. This is all about call money market. A very important concept that is burning also, and a latest evolution, that is a standing deposit facility scheme, shortly known as SDFS, a standing deposit facility scheme. Let's see what exactly this scheme is all about. A standing deposit facility scheme is one of the tools used by RBI in order to design monetary policy. Monetary policies of any country aim at right sizing and right costing. Sizing means how much money will be adequate for Indian economy in case of RBI, and costing means at what interest rate, okay. It means that in today's time, how much money will be adequate, sufficient to realize growth and developmental targets set by the government of India in newly launched Union Budget of 2022-2023, that is decided by RBI. And this scheme was operationalized in 2018-19 only, and still in PT a question is yet to be asked on this. So be careful. Any year a question might be asked by UPSC or various state civil services on SDFS. Okay. Now what exactly it is? So this tool of monetary policy is used by RBI to siphon out excess fund from the banking system. Siphon out means withdrawal, for withdrawal of money from India's banking system. If due to any reason Indian banking industry is flush with fund, they are getting too much fund in their accounts, demand deposits and time deposits, that might derail RBI's monetary policy, and that might make banks pay more interest on those deposits. As much, banks may not be able to forward fresh loans, because the money we deposit with banks, the money has a cost which banks need to bear. That cost is borne by a bank very comfortably, provided the money we deposit in our bank accounts, they are offered by banks duly as a loans to various kinds of customers. But suppose in economy borrowers are not many and banks are flush with fund, that this might damage banks' economic interest, and this might derail RBI's aims of monetary policy also. So in such a time, RBI may use SDFS scheme. It will withdraw money from banks. But will RBI pay a cost? Yes, RBI will pay. Will RBI use some collateral? So no. Let's say RBI pays an interest rate under it to banks. It means when RBI takes money from banks under this scheme, RBI pays an interest rate that is today known as a standing deposit facility rate. Right now, it is 5.65% per annum. It means that money from banks are not taken by RBI without paying any cost. Banks earn some profit out of that, that is 5.65% per annum. First such situation cropped up during demonetization, I mean 2016, when high value currency notes of 500 and 1000 rupees, they were demonetized by Government of India. When this was done, so what started happening? So that we can withdraw new money, we started depositing our cash available with us in 500 currency note or 1000 currency notes. We started depositing our bank accounts. So banks deposit started rising. But this money which we were depositing to the banks could not consider them as if they have mobilized deposits and start lending. Then a crisis will be faced by banking industry, because we were depositing our demonetized currency notes to withdraw newly issued currency notes of 500 and 2000. So there was no such measure. If something is not done, banks will consider this money as deposit and start forwarding long-term loans. It will create a crisis. So then and there RBI increased cash reserve ratio to 100%. It was increased to 100%. The circular was that all deposits made by any citizen or any individual and business house in India using demonetized currency, all will be transferred by banks to RBI. It means that for that deposit, cash reserve ratio will be made 100%, because SDFS was not available by time. Clear? So to manage the time and avoid banking crisis and monetary policy derailment, what RBI did on temporary basis, all currency notes which were being deposited by Indians with the use of demonetized currency, all were forcefully withdrawn by RBI from banks to itself. Okay? But it was felt that economic system can be flushed with fund due to many other reasons also. So let RBI have a proper and permanent tool, and this is how a standing deposit facility scheme was launched by Government of India and announced in the financial year 2018-19. This is all about SDFS. Changes in this rate, just one small bit of information, changes in this rate affects the operational cost of banks, and this way it signals bank to change their lending rate. It means if SDFS rate has been increased, so banks earn more interest, and it is expected by RBI that banks will offer cheaper loans. Clear? On the other hand, if FCF rate is decreased, so what happens? Banks earn lower interest, their income goes down, and ultimately banks are forced to increase interest rate. That is why I told you that actually this rate and this scheme which evolved as a scheme, got launched as a scheme, over the time it became a tool for RBI to put in place the desired kind of monetary term, that is liquidity management framework. Let's see what exactly liquidity management framework is. It is popularly used by RBI as LMF. Okay, so let's see what exactly it is. Liquidity management framework is an idea related to India's monetary policy which was operationalized by RBI in 2014-15. It means that LMF was operationalized in 2014-15 by RBI, and since then the framework has been modified and revised few times depending upon need of the hour. What exactly this framework is? Framework actually means a kind of guideline, okay, for stakeholders, and here stakeholders are none but banks operating in India. Okay, this was aimed at checking volatility in interbank call market. It means that I am referring to call money market. Watch my previous video to have clear idea about call money market. What exactly a call money market is? Call money market is a market in which banks borrow and lend to each other and from each other. That is why we call it interbank market. Okay, shortly known as CMM. In case of India, till that time, high volatility was found in India's call money market. It means that on a particular day, money is more in demand and less in supply. On another, money is less in demand and it is more in supply. Due to these two variables, you generally find high volatility in any market, be it foreign exchange market, be it call money market, whatever it be, because demand and supply of money, if there is a wider gap, the volatility is but natural. So in case of India's call money market also, high volatility was seen by RBI. So to tame down this volatility, to tame down the element of volatility in India's call money market, RBI operationalized a new framework, a new guideline, a new set of rules and regulations that is known in India as liquidity management framework. What is done under it? As per it, the combined repo borrowings of all banks put together on a day cannot be more than 1% of the net demand and time liabilities of all the banks put together. Clear? कि suppose on a particular day, suppose कि today that is Friday, okay, all banks want to borrow money at repo rate, okay. So how much they can borrow? They can borrow maximum up to 1% of their NDTLs. It means कि all banks operating in India, whatever money they have in their demand and time liabilities in net form, not more than 1% of that. This is known as overall ceiling on repo borrowing of banks in the country. Clear? Inside this, there is basically inside limit also. Individual banks also are bound to follow another rule, that is, individual banks cannot borrow more than 1% of their individual NDTLs on a day through repo route. It means कि all banks together can't borrow more than 1% of their total NDTLs. That is precisely speaking around 1,37,000 crore rupee today. Okay. But in case of individual bank, suppose a State Bank of India wants to borrow money, so they cannot borrow more than 1%, more than 1% of its NDTL. Now say, I am talking two things. All banks cannot borrow more than 1% of all of their NDTLs, and on individual bank there is a limit. Individual bank cannot borrow more than their NDTL under this route, and of that, of this 1%, 1% of NDTL, of this 1% of NDTL, just say 1% of NDTL, a bank will borrow 25% of it at repo rate, and rest of 75% at term repo rate. That is also known as term repo route. Repo means here basically 1 day, and term repo stand for 7, 14 and 28 days. Whatever a bank wishes, it can go. Suppose SBI wants to borrow 100 rupees from call money market, so 25 rupees it will have to borrow as overnight loan, and rest of 75 rupees it will have to borrow for either 7 days, 14 days or 28 days. So this is all about liquidity management framework. What is significance of this basically framework? Significance is this: if in economic system on a particular day more fund is supplied than required or less fund is supplied than required, so both will create crisis for monetary policy, okay, related to exchange rate stabilization, inflation targeting and desired kind of monetary policy. So what RBI did in 14-15, it put in place a liquidity management framework. Banks today know what is their limit to borrow from call money market of India. So much panic doesn't occur, and that is how volatility in India's call money market has been tamed down by RBI. Such frameworks were already used at least by developed world and their central banks, but it entered India's monetary policy domain a bit late by 2014-15, and that was the period when India was feeling the impact of globalization on India's monetary policy. These things we will discuss in my upcoming videos in future. Thank you for watching this session. Subscribe this channel to get regular short videos on one term of economics in one video. To get regular updates, contents and free quizzes for your examination, state or civil services UPSC, you can subscribe to our channel. Rather, I will recommend you to just subscribe to this Telegram channel and get benefit out of it. Thank you for watching the session. Let's meet in my next session.